Assalamualaikum warahmatullahi wabarakatuh. So our group 8, will present about property, plant and equipment and also investment property. So our group have 5 members, which is Najwa, IELYA MAISARA, NOOR AMIRA, NOOR ATIKAH and NAJWATUL FARHANA. So in this topic, we will talk about property, plant and equipment in MFRS 116 and investment property in MFRS 140 that include introduction, recognition, measurement, depreciation, de-recognition, reclassification, and also issue about this property, plant and equipment and also investment property.
The definition of PPE. So, based on MFRS 116, property, plant, and equipment are tangible assets that are held for use in the production or supply of goods or services, for rental to others, or for administrative purposes, and are expected to be used during more than one accounting period. So, here I would like to highlight if the building is used for rental purposes, then MFRS 140 investment property might apply instead of MFRS 116. So, just bear it on your mind that the rental purpose relates more to other vehicles or machines. Next, the definition of investment property. Based on MFRS 140, investment property is property which is land or building or part of a building or both held by the owner or by the lessee under a finance lease to earn rentals or for capital appreciation or both. However, MFRS 140 is not for building or land that used in the production or supplies of goods or services or for an administrative purposes, because it is for MFRS 114 under property, plant and equipment, and MFRS 140 also not for sale in the ordinary course of business, because it is on MFRS 102, which is inventory. Recognition of property, plant and equipment. The cost of an item of property, plant and equipment shall be recognized as an asset if and only if it is probable that the future benefits associated with the item will flow to the entity, and it means that enterprise will receive rewards from the uses of an asset, and on the other hand, it also will carry risk associated with the asset, for example, repairs. The second condition is the cost of the item can be measured reliably. So, if you cannot measure it, then you cannot account for it as an asset. And these two conditions apply for both for initial costs and costs incurred after initial recognition or subsequent costs. Next is how to recognize investment property in your financial statements. So you can do it in two conditions when the two conditions are met. First, it is probable that the future economic benefits that are associated with the investment property will flow to the entity. Well, think about associate reward and benefits. And the cost of the investment property can be measured reliably. So, this rule is very similar to the rule in MFRS 116 for property, plant and equipment as I mentioned earlier.
Okay, next we will discuss about measurement of PPE. There are two types of measurement of PPE. First is measurement at recognition. Second, measurement after recognition. And measurement at recognition is known as initial cost. After recognition is known as subsequent cost. Initial cost is the first cost that we record PPE. It comprises of the purchase price of the asset and directly attributable costs that are incurred to bring the asset into the present location and condition, such as cost of site preparation, professional fee, initial delivery and handling costs, installation and assembly costs, and borrowing costs. It also comprises of removal costs, which is cost of dismantling and restoration costs. And in this removal cost of asset in the future, the initial estimation in the present value of removal cost need to be included in the calculation of initial cost. There are also the costs that cannot be capitalized and should not be included as a part of PPE. For example, admin of general overhead costs, cost of opening new facilities, cost of introduction of new product, cost of new training, initial operation losses, cost of day-to-day services of asset, cost of small parts, quick rent, tax assignments, and fire insurance. This is a type of cost that cannot be included as a part of PPE and cannot be calculated as initial cost. The cost of an item of property, plant and equipment is the cash price equivalent to the recognition date. So, if the payment of the asset is postponed to the later date, the amount shall be discounted. At the difference between the future date and the cash price equivalent is called interest. And if the item is required to exchange for the other non-monetary asset, then it shall be initially measured at the fair value.
Next is initial measurement for investment property. An investment property shall be measured initially at its cost. Transaction costs shall be included in the initial measurement. The cost of a purchased investment property comprises its purchase price and any directly attributable expenditure. Directly attributable expenditure includes, for example, professional fees for legal services, property transfer taxes, and other transaction costs. If payment for an investment property is deferred, its cost is the cash equivalent. The difference between this amount and the total payments is recognized as interest expense over the period of credit. These costs include costs incurred initially to acquire an investment property and costs incurred subsequently to add to, replace part of, or service a property. However, you must be careful because we do not include any startup expenses to investment property, well, unless they are necessary to bring the property to the condition necessary for it to be capable of operating in the manner intended of management. We also do not include any operating losses in pre-operation stage or until reaching a full capacity. Lastly, an abnormal waste of material, labor, and other resources incurred a development of investment property. This is an example on how Genting Malaysia Berhad disclosed a significant accounting policy about initial recognition of investment property.
Subsequent measurement is a measurement that you recognize after your initial measurement. So, subsequent measurement is divided in two, which is cost model and revaluation model. Company may choose only one subsequent measurement. If company use cost model in measuring the asset, they have to use it consistent in a way that their entire class of asset use the same subsequent measurement. If company use cost model, they will count as assets as cost minus accumulation depreciation minus impairment loss. However, if company use revaluations, revaluation means that they value the asset again and compare it with fair value, then you depreciate it. Fair value is actually a market price. So when you revaluate, you will either get a surplus or deficit on revaluations. How do you know it's surplus? When you compare it fair value and carry amount, the fair value is more than the carry amount, so you will get the surplus on revaluations. But if the fair value is lower than the carry amount, so you will get deficit. So this is an example for accounting policy in Gamuda company, which is it states that in cost model, all items of property, plant and equipment are immediately recorded at cost. And in subsequent measurements, it states that subsequent to recognition, property, plant and equipment except for freehold land and state at cost net of accumulated depreciation and accumulated impairment loss. So this is the example of accounting policy for the Gamuda company. If company choose a cost model to in subsequent measurements, so the accounting treatment for the financial position is measured at cost less accumulated depreciation less accumulation impairment loss. In profit and loss, depreciation expense and impairment loss incurred in the current year. So this type of asset for this cost model can use for property, plant, equipment and also for investment property. This is the example for financial statement that shows that property, plant and equipment is measured at cost less accumulated depreciation less accumulated impairment in loss. So if the company used a revaluation model for subsequent measurements, so the accounting treatment for financial position is for asset measured at fair value less accumulated depreciation less accumulated impairment loss. And for equity, revaluation surplus is recorded as asset revaluation reserve. And the recognition of asset in equity and any revaluation surplus amount is transferred to retained earnings. The accounting treatment for profit and loss, for the first revaluation after initial recording, the treatment of increase and decrease in carry amount is pretty straightforward. The increase is credited directly to the revaluation surplus. So any increase goes to OCI and decrease in year 1 go to income statement as expenses. So this is the same concept. Anytime fair value is below than the cost, you are dealing with expenses and income. Once the fair value is above the cost, so you are dealing with OCI. This revaluation model only used for property, plant and equipment only. So this is the example for illustrative journal entry. So look at the land. The cost for the land is 100,000 and the fair value for year 1 increased 120,000. We will record it as debit land 20,000 and credit revaluation surplus for land 20,000. So the revaluation surplus will be recorded in OCI. So same goes to the fair value for year 2. The fair value for year 2 is more than the cost. So we will debit land and credit revaluation surplus. So for the building, the cost is 500,000, which is more than the fair value in the year 1. So we will record it as a debit loss on revaluate 50,000 and credit the building 50,000. So the loss on revaluate will recorded as expenses, but the fair value for year 2 increased 460,000. So we will record it as debit building and credit loss on revaluate, which is we recover the loss that happened in year 1.
Next, we move to subsequent measurement of investment property. The entity has two options to account for the investment property at reporting date. First, fair value model, and second, cost model. Fair value model. The entity which chooses fair value model to account for its investment property after initial recognition will measure the investment property at fair value. All investment property should measure at fair value at the end of each reporting period, provided fair value can be measured reliably. Changes in fair value, whether gain or loss, should be recognized in profit or loss for the period in which they arise. The consequence of adopting this measurement basis in that no depreciation is ever recognized. IAS 40 encourage the assessment of fair value by independent, appropriately qualified and experienced professionals, but does not require it. Fair value. Definition of fair value is the amount for which an asset could be exchanged between knowledgeable, willing parties in an arm's-length transaction. The fair value of investment property should reflect market conditions at the end of the reporting period. The best evidence of fair value is given by current price in an active market for similar property in the same location and condition. Where the entity cannot determine reliably the fair value of an investment property, the cost model in IAS 16 must be applied to this particular investment property until it is disposed of. Next, we move to cost model. After initial recognition, an entity that chooses the cost model shall measure all its investment properties in accordance with MFRS 116 for that model, other than those that meet the criteria to be classified as held for sale. Investment properties that meet the criteria to be classified as held for sale or are included in a disposal group that is classified as held for sale shall be measured in accordance with MFRS 5. Okay, next we are looking at accounting policy that Gamuda Berhad used for their annual report in 2020. For this note 14, which is stated investment properties that carried at cost less any accumulated depreciation and any accumulated impairment loss. And as it's stated in the slide, Gamuda Berhad are using cost model for investment properties, same as PPE, as what IELYA have explained before this. Okay. In financial statement of Gamuda Berhad also stated one of the passage about investment properties. As you can see, this is a financial statement of 2020, and it stated that there are costs and accumulated depreciation and net carrying amount. So we can conclude that Gamuda Berhad are using cost model for investment properties and also PPE.
De-recognition of PPE. Carry amount of property, plant and equipment shall be de-recognized on disposal. That is when we sell the asset into the finance lessee as a lessor or donate the asset. The asset also can be de-recognized when it has no future economic benefit as expected for its use. And because of this, gain or loss may arise, which can be calculated as net disposal minus any carry amount of property, plant and equipment. Gain or loss from disposal of PPE are included in the net profit or loss, but not as revenue.
We are moving to the recognition of investment property. As you can see in the slide, Investment property must be derecognized when it is disposed of or permanently withdrawn from use where no future economic benefits are expected from its disposal. This is from IAS 40, para 66, and from IAS 40, para 69, stated that the profit or loss on the recognition is recognized in P&L unless it relates to a sale and leaseback, and IFRS 60 requires the profit or loss to be deferred. And also in IAS 40, para 72, stated that compensation receivable from claims is recognized in profit and loss.
Okay, we move to transfer investment, which is transfer to investment property or transfer from investment property. According to MFRS 140, transfer to or from investment property will happen if that there is a change in use. First, transfer from MFRS 140 investment property to PPE. MFRS 116 occur when there is commencement of own occupation. For example, the building we rented out, then now we want to use for administrative office. So there's a change in the use of the building from investment property we rented out to now PPE, owner occupied property. Second, MFRS 140 to MFRS 102 inventory. Commencement of the development with view to sales for a transfer from investment property to inventories. This is the change in the use the asset from investment property MFRS 140 to inventory MFRS 102. So third transfer MFRS 116 PPE to MFRS 140 investment property occur when the end of owner occupation. Example, building previously used as head office and now is leased out to another entity, maybe because of financial problem. So this is the example of the transfer from owner occupied property PPE to investment property. So the last transfer is transfer MFRS 102 to MFRS 140. Commencement of an operating lease to another part. We transfer from inventories to investment property. Accounting treatment of transfer. Okay, transfer from investment property to PPE. So at the date of transfer, we measure using cost, fair value, or carrying amount at the date of transfer. Then after the transfer, subsequent measurement at cost model of or evaluation model in accordance with MFRS 116. Next, transfer from investment property to inventory. At the initial, we measure using cost, fair value, or carrying amount at the date of transfer. Then subsequently measure at lower or of cost or NRV accordance with MFRS 102 PPE to investment property. At the initial measurement at fair value, any difference from CA shall be treated as a revaluation. Subsequent measure at cost model or fair value model accordance with MFRS 140. From inventories to investment property at the initial measurement using fair value. So any difference recognized in P&L and the subsequent measurement using cost model or fair value model MFRS 140. Okay, this is the example of transfer based on the annual report of YTL Power International Berhad. YTL Power International Berhad was the subsidiaries of YTL Corporation Berhad. So from investment property transfer to BBE in 2020 and also transfer investment property to inventories from YTL International Berhad.
Okay, next we moving on to the disclosure of PPE. For each class of PPE, a company must disclose the measurement days, the depreciation method, and the useful life use of asset, or equivalently the depreciation rate. Similarly, the company must reveal the gross carry amount and the accumulated depreciation at the gross carry amount of the beginning and the end of the period. Finally, the company must declare the reconciliation of the carry amount at the beginning and the amount at the end of the period.
Next, disclosure of investment property. Financial statement shall disclosure the measurement model used by entity. First, the cost model or the fair value model. Next, the circumstance of which entity has opted the classification option for property interest. And the third, how entity has determined the fair value for investment property. Next, any amount recognized in statement of profit or loss in respect of any rental earnings from investment property, any operating expense such as repair and maintenance, and lastly, any movement in fair value of investment property. Financial statement shall disclosure. For the investment property under cost model, the entity should disclose depreciation method, estimate of useful life, its gross carrying amount, any amount of impairment loss. Next, for the property for which fair value could not be determined, and the identity has to measure such property under cost model. First, nature of the investment property. Next, reason why the fair value is not determined. Last, for the property which has been disposed of, the entity should disclose. First, its carrying amount on disposal date and any amount of gain or loss on disposal.
Okay, now I will talk about the issues that I found in the article, which is fixed asset not in use during the pandemic and what is their impact on the financial statement. So the case is COVID-19 pandemic given rise challenge for the companies. The crisis that happened by COVID-19 pandemic give many challenge for all companies, affecting their management of resource, their operations, and also their business transformations. So the issue is, should asset continue to be depreciated? These issues require the company to evaluate how their asset will be used and what is the impact on the financial statement. So, the depreciation is only allowed to cease if the assets are classified as held for sale in accordance with IFRS 5 or if it is written off. Another scenario where depreciation ceases is when the entity uses a usage-based depreciation method. For example, the unit of production method, which does not generate any depreciation charge if no production activity taken. So, if depreciation is not allowed, which is not usage-based, it is advisable to review the residual value and useful life such asset, which may lead to select another depreciation method that will allow reflecting the pattern of use to be applied to those assets, and which would be accounted for as change in accounting statement in accordance with IAS 8, which is accounting policies change in accounting statement and errors.
We will discuss the issue of the investment property. The study investigate the value relevance of investment property of Malaysian listed firm based on cost model and fair value model for measuring their investment properties. So the sample was selected using a simple random sampling so that all listed firm has equal chance to be selected. So a final sample of 108 firm year from various industry was selected for a period from 2018 until 2019. So next, the main issue of this case is the first issue to study about the selection of cost model and fair value model among listed firm in Malaysia. The second issue is to investigate whether investment property is value relevant. Okay, so the first issue to study about the selection of cost model and fair value model among listed firm in Malaysia. So total 106 firms have been selected, and among them 52 firms did not own an investment property, while 54 firms owned investment property. Okay, so from the total of 54 firms that own investment property, 27 out of 54 equal to 50%. 50% of the firm are select cost model and 50% selected fair value. So from the perspective firm, from small firm, 60% selected cost model and the rest was the fair value model. So while large firms, 34.5% selected cost model and 65.5% selected fair value model. So as the result, majority of large firm prefer fair value model, whereas majority of small firm prefer cost model. Okay, next issue, to investigate whether investment property is value relevant. So the author tested this issue using 3 models. Okay, the result from model first showed that BVOE, which is book value of equity, is a value relevant regardless of investment property valuation model selected. So model 2 shows that BVOE and investment property are value relevant regardless whether cost model or fair value was selected. Lastly, model 3 shows that NP of fair value model is more relevant than NP of cost model. That's it from us. Thank you.
So for the summary, the property, plant and equipment use IAS 16, while investment property use IAS 40. So the purpose of property, plant and equipment is for production or supply of good and service, for administrative purpose, or for rental to others. But for the investment properties, held to earn rental or for capital appreciation or both. So the type of PPE and PPE is vehicle, machinery, land and building, while the investment property only for the land. The subsequent measurement for the PPE usually recorded using cost model, while the investment property usually recorded using FV model, which is a fair value model. Okay, next, depreciation for PPE is for both cost model and revaluation model, but for the investment property, depreciation is only for the cost model, but no depreciation for fair value model. So the impairment for PPE is post cost and revaluation model, and also for the investment property is only for cost model and no impairment for fair value model. For gain or loss for PPE, if any revaluation changes of fair value should be recognized in statement of other comprehensive income that will be not classified. But if any gain or loss for investment property from a change of fair value should be recognized in statement of profit and loss. So that's all from us. Thank you.